a las próximas intenciones por parte de los bancos centrales. Vamos a hablar de todo ello con Edward Moya, es Market Analyst en Marketpulse y Oanda. Edward Moya, thank you so much for having us a few minutes. Good afternoon from Spain.
Thank you for having me.
Edward, as we say, we are about to start 2023 and we are trying to take the pulse of markets. But first, I would like to insist on analyzing the Federal Reserve messages as at its last monetary policy meeting was the prior week. How did you see Jerome Powell, and which are for you the main highlights of his message?
I think Fed Chair Powell was very clear in his message. He's stuck to the hawkish tone. He said that there was ongoing rate increases was going to be their strategy, which really surprised a lot of traders. There was, going into that meeting, we saw consecutive month-over-month declines with inflation. There was optimism that the Fed was going to possibly be one and done with rate hikes, and now you're starting to see a market that is not convinced that the Fed will follow through on that. But I think there's still this I think big risk out there that the Fed could still deliver much more tightening than the market is expecting. And I think that's why you have a wide range of expectations for how next year will unfold. But right now, I think the Fed is not backing down. They're going to deliver more rate hikes. So February 1st is the next meeting, and I think they might downshift again, but I think they're going to be data dependent, and we'll see exactly how many more hikes come after that February 1st meeting.
Did Jerome Powell convince the market by talking about the possibility of a soft landing?
I think there's this belief here that, many traders, and if you take a look at Fed fund futures, they're pricing in rate cuts for the end of next year. And that's something the Fed is really trying to push back against. So I think the markets are hearing Fed Chair Powell, and they know what he's saying, and they know that he has to say that, because if he provides any hint that they're going to be done with tightening, you'll see that reflected in the curve, and that would actually be easing, and which is something they don't want to do. So I think traders, they know the Fed is going to remain data dependent. Right now the trends are fairly convincing that inflation is coming down. We're finally starting to see weakness in the service sector. So wage pressures should start to ease, but we're nowhere near target. So I think there's when inflation comes to 4%, does it get stuck there, or does it really continue to move towards 3%? I think we're not going to have the answers until the end of next quarter. So I think there's this period of quite a few meetings where you're not going to be able to really, I think, firmly believe what the Fed will do at the end of next year. So this is going to be a wait and see, I think, period for traders. And I think as you take a look at the impact of the these first round of rate hikes, you're going to start to see a stronger deterioration in the economic data. So I think there's expectations that we're going to have to downgrade earnings significantly. So I think first half of the year, I think the consensus call right now is that we're going to see some weakness in equities, and that's probably why you're seeing a lot of investors focus abroad or focus getting back into fixed income right now.
If we put our focus on markets, I would like to talk about Tesla. It has fallen more than 60% year to date. Fears about Elon Musk leadership skills persist, especially after the purchase of Twitter. What's your perspective, your outlook, your forecast for the company?
Well, Tesla is stock. I mean, the worst thing that happened to Tesla was this Twitter acquisition. You saw Musk had to force sell some of his shares to free up capital, and you're probably going to see that this until we have a new Twitter CEO put in place, until we really start to see Musk focusing more of his energies towards Tesla. The stock is going to struggle, I think. I think there's optimism here that still Tesla, they still have a big lead against all the other major auto manufacturers. They still should have a strong, I think, performance next year. I think there's lots of regional specific issues, whether it's China's reopening, whether it's setting up factories in different countries. But I think overall, Tesla is still in a good position to, I think, outperform the rest of the EV space. So I think losing 2/3 of your value, you have to really take a good look at the company. But I think there's still just taking a look at the trajectory of the economy and how we could still see robust, I think, demand for EVs, given the I think the long-term outlook for energy prices. I think we're still looking at a very tight market. So EVs should still, I think, do fairly well. So Tesla will probably, I think, lots of potential next year. And I think as long as we start to see Musk and I think continued momentum here, I think Tesla is right now at a very attractive level.
Meanwhile, if we look at crude oil, the easing of COVID restrictions in China, as well as the recently imposed price cap on Russian crude, should keep oil prices supported in 2023. That's one part of the vision of the analysis. But we are seeing how global growth concerns are still there. So which is your vision about the oil prices next year? Which is your outlook?
I think the short-term crude demand outlook, it might get revised lower slightly, but this oil market is still tight. OPEC Plus has signaled they are going to do what's needed to make sure that the market remains somewhat in balance. And I think what you're going to see is, over the past, couple of quarters, it seemed that we were constantly talking about, well, where can we get these extra barrels of crude? Were we going to see some progress in reduction in sanctions for Venezuela or Iran? Were we going to be able to revive that deal? None of this is expected to come true in anytime soon. So I think what you're also seeing is, these oil companies, they're not delivering massive investments in capex. So we're seeing, yes, a little bit of a move higher in that investment, but we're not going to get those rewards anytime soon. This market's going to remain tight for many years. So I think you're probably looking at a market that global inventories are still at low levels. I mean, the U.S. is now starting to reveal their plans on refilling the SPR. You're going to have strong support here, even as this economy heads towards a recession. It's not like all parts of the economy are going to be hitting a recession. You'll see some relief in other parts that have been beaten up for quite some time. So I think oil is probably going to be one of those trades that there's, I think, more risks to the upside than down. And once China's reopening really gains momentum, and that might take some time. I mean, there's some issues that they're having with their current reopening, but I think you're probably going to see that oil is going to have a strong case to trade well above $80 early next year.
Thank you so much for your analysis, Edward Moya. A pleasure, as always.
Thank you.
Pues nos quedamos con el análisis.